All right, we're live. Let's do this. All right, I'm Mitch Goldberg. You're listening or watching, depending on where you are. Be the boss of your money. And this is our live stream. We talk about the market, personal finance, things that you need to know so you could get the most out of your money. Your money works well. You work hard for your money, and you want to work. You want your money to work hard for you. It's like a tongue twister, right? It's been a long day. All right, so let's take a jump into it. Oh my god. I know, yawning in your face in a live stream. It's just so rude. I'm sorry. Look, it's been a long ass day today, okay? Oh, am I allowed to say that? It's been a long day. A long day. Just oh my god. It was okay. I hope you had a good day, by the way. So the Fed finally had its meeting. The September meeting is now out of the way. The Fed did exactly what we expected. We've been talking about this for a couple of weeks. There was a 99% chance that the Fed would do nothing at its interest rate policy setting meeting today, and it did nothing today, as expected. It indicated that there could be another hike this year. There's only two more Fed meetings this year. There's a November meeting and a December meeting. We'll see what the Fed has in store for us. We're going to have to see what inflation looks like, and based on that, we might see another rate hike. We might not. The Fed is not all knowing, and I know a long time ago when I got into the business and throughout the 90s and early 2000, it did see that the Federal Reserve, the Fed is not all knowing. And when I got into the business, early 1990 and then through the 90s and early 2000s, it did seem like the Fed was all knowing, but it is not all knowing, as we have learned many times over. And the Fed has actually tried to become very transparent, give clues about what it's looking at in its determination of setting interest rate policy. And it continues to do that. And I think it is actually better. I think it's better to have open communications, and that's what the Fed is. It's a kinder, it's a kinder, gentler Federal Reserve today than it was 30 years ago. It's still data dependent. Why was it hawkish, the meeting today? Hawkish meaning that, interest rates could go up or stay higher. It's basically all about interest rates staying higher for longer. Expectations where we'd see 4 rate cuts next year. Now that's been pared down to 2 rate cuts next year, possibly. But either way, the 5% federal funds rate is here to stay probably for at least another year, unless we go into a significant recession. And in that case, all bets are off. But the Fed won't be able to cut rates fast enough to arrest the recession. Just remember, recessions are a permanent part of the economic cycle. There's no there aren't just recessions and then economic expansions. There are both. Okay, they're part of the economy. They're not separate from each other. They're not mutually exclusive. They are different sides of the same coin, okay, of the economy. If you think of the economy as the coin, one side is economic expansion, one side is recession. It's just the way it goes. Recessions are necessary. They cull the weak companies. They get rid of weak hands in investing, people who don't have the stomach to hold on to their investments for the long term. Recessions push those people out. Stocks find their way back to their rightful owner. Those owners make money in the market in the recovery. And then the same people who sold in the last recession to get out because they couldn't take the pain, they wind up getting back in at the top, and then they lose more money. And it happens over and over and over. It never stops. I've seen it many times. Yeah, I'm like an old timer now in this business. So I've seen it many, many times. So let's take a quick gander at how the major averages did. So the Dow up 76. NASDAQ had a pretty significant down day, down over 200, but that's because stocks like Google and NVIDIA came down. But it also has to do, I think, with the recent IPOs of Instacart. ARM Holdings have come down, and it just goes to show you that the street was not ready for more IPOs. People thought like if Instacart and ARM Holdings would go public and they would go up in the IPO, like aftermarket trading, they would have that IPO spike, that would mean investors are back to being, animal spirits and comfortable and throwing money into the market again. No, not at all the case. And you have to think of it like this. If good names, established companies like Instacart and Arm Holdings, IPOs couldn't hold water, doesn't really speak well for the market. We talked about this pretty extensively already yesterday, but even more so today. Oil, even though it's been rising up a lot, it has been coming down a bit. Oil down about a little bit over 1% today, so down 93 cents. 10-year up almost 4.4%. To me, I'll tell you why I think that will go higher in a moment. We're going to take a look at the bond market in a second. The VIX is moving up a little bit back to over 15. I don't think that's anything significant, but if that spikes up to like a quick move to 20, then we have to start talking about, if you're a short-term investor, you're in trouble. If you're not a long-term investor, you get through this. But remember, if you are facing a financial need and that money you have that you have a financial need for is still in the stock market, it should money that you need over the next, we could pick the time, but 12 months, 24 months, it probably shouldn't be in the stock market. So if you do have a stock market correction, that money won't be affected. All right. Savings and money you need over the next year or two are different than investments. Bond market. Okay, here's what I was saying. The 20-year is 4.6. The 7-year is 4.5. So why is a 10-year only 4.399? So the 10-year should be somewhere between 4.5 and 4.6. So let's call it 4.65%. That's where it should go. That's probably right. I think it's going based on the Treasury, the yields on either side of it, on top and bottom. But at that point, we're going to have to start talking about a 5% 10-year yield on the yield of 5% on the 10-year Treasury. And that'll have an impact on the market and valuations, et cetera. Instacart, I mean, they just went public. They're already setting 52-week lows, but the stock went as low as $29.96. So it broke below its $30 IPO price earlier this week. So all the gains from Instacart are basically evaporated. It was as high as almost 43. Now it's 30. So basically anybody who bought it in aftermarket trading is down. Arm Holdings, 52-week low, went down to the 52. It was high as 69. The company IPO'd at 51. So the fact that it's 52, it just, between Instacart and Arm Holdings, it doesn't speak well for investors feeling good about the market and for getting aggressive. Okay. Just another knock on why this market has been kind of weak based on the hawkish meeting from the Federal Reserve today. You know, and the futures were up pretty nicely this morning, but everything still closed down today. We're still in these summer doldrums that started in July, and it's hard to figure out a way out of it. The only thing I could see that would arrest it is if stocks went down to a good level lower, and then the September quarter earnings start coming out. So the September quarter is going to be over in 10 days. And about a week after that, so let's say in 17 days, we're going to start getting quarterly earnings. And if they're anywhere near decent and the market's already down, that could be a catalyst for stocks to go up. Are we there yet? You know, just reading the tea leaves, it doesn't look like it yet. Okay, let's do a little opinion piece here. When you see articles that say Dow is down or the major averages are down for 2 months. By the way, you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. When you see an article that says the S&P or the NASDAQ, whatever, was down a month or 2 months, or its biggest weekly losing streak in like a year or two, these things are scary, but we know that in a 20-year time period, which is, you know, 240 months, 2 months is nothing. You think about investing for the long term, 2 months is really a blip. The other thing is, do you want to keep buying stocks when the market keeps going up, or do you want the market to come down so you can invest when the market's lower? When I say buying stocks, it could be in the form of exchange-traded funds, mutual funds, 401k plan, individual account, whatever it is that wherever you buy your stocks, whatever account you use. These articles are meant to scare you. They're meant to shake you out. That's why I look at it. Don't let them scare you. You know, down 2 or 3 months in the major averages in a row is not a big deal in the scheme of things. Okay. So just my little all opinion piece that I think the thing that helps my clients is as their financial advisor is I know what to pay attention to. And paying attention to an article that points out how the market's down for a month or two or 7 or 8 weeks in a row, that's basically useless information if you're a long-term investor. I want to take a look at something else here. Let's just take a look here. This is whoopsie day. I'm here. I'm right here. Okay, right here. We got that. Pop myself up here. This is our Client First Strategy Facebook page. This is where we broadcast our live stream to here and LinkedIn and YouTube. But if you would kindly subscribe to our Client First Strategy page, you see that Client First Strategy Inc. Okay, it's right up there. And the latest post to the website is from my partner, Bobby Bird. He went to a special educational professional development meeting. And I'm glad he went because he went to the meeting. He's going to bring back all kinds of really good information back to us that we will be using in our practice to benefit the families that we serve. So thank you, Bobby, for making it. Damn, he is one good-looking dude, isn't he? Absolutely. That's my partner. All right, and then let's take a look at something else that we're going to look at because I mentioned health savings accounts, okay? Let's talk about health savings accounts. Okay, this piece is from Fidelity, but it's a really good piece. Okay, so I'll put that back up in a second. We're almost done with the show. By the way, this piece that I'm about to show you, if you want me to email it to you, just say the word and I'll email it to you. If you have any questions about what we're talking about, whether if you're watching in the live or the replay, please ask me in the comments. If you don't mind, give us a like or words of encouragement or something. And this way it'll help spread the good word about the work we're doing here for our firm, in our practice, and all the education that we share every single day. And then your contacts will see it. Your friends on Facebook could see it, and it just spreads the good word. Okay. Then again, don't forget to like our page, Client First Strategy, subscribe to our YouTube channel, Client First Strategy on YouTube. Okay. So health savings account. This is just, if you use it as a retirement account, it could be a really great thing. In other words, you have the option of having a higher deductible in your health insurance, but that deductible money could also go into a health savings account. You get a tax deduction on the money you get a tax deduction on the money that you put into a health savings account, similar to the tax deduction for making a contribution to an IRA. But with a health savings account, when you take the money out, providing it's in there for over a year, if it's for qualified medical expenses, the money comes out tax-free. It doesn't even have to be in there for a year. You could use the money in the year that you made the contribution into it. But the money would come out tax-free like a Roth IRA. So you get the benefit of a tax deduction like a traditional IRA. You get the benefit of a tax-free distribution like a Roth IRA. But there's a few nuances to this that you should know about. The first thing is this. A health savings account, when you use it as a retirement account, really, what it really means is you have to be able to leave the money there for the long term, because within a health savings account, you can invest the money into mutual funds, for example. You can invest the money and it can grow over time. So if you're not going to touch the money for 10 or 20 or 30 years, it could be a pretty significant addition to your retirement assets and your retirement income. The thing is, the money, when you take it out, has to be used for qualified medical expenses. Can't just be used to pay rent or mortgage or real estate taxes or food. It's got to be for a medically necessary expense. I know a lot of you could kind of make the case that without food we wouldn't have life, so food's a medical expense. But for these purposes, it's not going to count. Okay, so when you use a health savings account and you could afford to not use the money in the plan in the health savings account, then you could use the health savings account like a retirement account. And some of the qualified expenses, I'll just pop this up. Okay. These are a list of qualified medical expenses, which you might not have even thought about, but ambulance, acupuncture, lactation expenses. Although if you're retired and you're holding on to your health savings account, you're probably not going to need it for that in retirement, but that's besides the point. Optometrist, osteopath, oxygen, psychologist, psychiatric care, surgeries. You can even use it for vasectomies, wheelchair, weight loss programs for treatment of a doctor-diagnosed disease, hospital services, insulin, fertility enhancement, eye surgery, eyeglasses, drug addiction. So there are so many uses for a health savings account. So why do I talk about this? Because when you do retire, let's just assume you're a typical average person, you retire in your 60s, maybe later, and you've been putting money into a health savings account since your 20s or 30s or 40s, you could potentially accumulate a lot of assets in that account because it could grow a lot from investing in mutual funds, potentially grow. Past performance is no indication of future performance. So having said that, you could wind up with a lot more money in your health savings account than when you put into it. And when you retire, you just have to expect that your medical expenses are going to go up because you're going to have more medical needs. Just the way life works. So you could take out the money from your health savings account decades after you put the money in. So you could use this money in your retirement to pay for some of your healthcare expenses, qualified healthcare expenses. So you take the money out tax-free. You don't pay any taxes on the distributions, including the growth. And that is why it's such a good deal for investors. So it's basically you're saving money in advance for out-of-pocket healthcare expenses. And that's what makes the health savings account such an advantageous type of account to have. Plus, you got a tax deduction on the money you put into it. So some people say, well, what if I want to use the money for something else? And I have to say, believe me, if you live to see retirement, and hopefully you do, I can promise you're going to have healthcare expenses. It's the way life works. So instead of taking money out of your Roth IRA or your traditional IRA to pay for your healthcare bills, you could take the money out of your health savings account, get the same benefit of growth as your IRA or Roth IRA, except with the health savings account, you get the tax deduction similar to a traditional IRA, and you get the tax-free withdrawals similar to a Roth IRA, providing you use the money in the future for qualified healthcare expenses. That is why we financial advisors make such a big deal about having a health savings account. Thanks so much for watching. I'm going to let you guys go now, and I will see you tomorrow. Thanks so much. Bye.